Welcome back. Let's talk now about what our next guest calls the pandemic paradox as the labor market, where we find labor shortages amid a large amount of people that are still unemployed and companies very much willing to hire. We're joined now by Gary Schlossberg, Wells Fargo's global strategist. So Gary, I do want to start on that pandemic paradox. I'm curious to know how you explain, so many of these labor shortages that we're seeing, considering that we still have so many folks that are unemployed.
Well, I think a lot of it just has to do with the nature of the economic cycle. We're right in the midst of what we would call very much a V-shaped economic cycle. This a direct byproduct of the pandemic, massive layoffs over a year ago, and then followed by a very strong bounce back in the economy. That created inevitable dislocations, people leaving their jobs in search of jobs in other industries. Getting settled in, very difficult for those frontline industries hit hardest by the pandemic to pick up the pieces as demand recovered. On top of that, in a very dynamic labor market with very high turnover, you do get people voluntarily quitting, moving to positions where the pay might be higher, the working conditions better. All this kind of churn creates shortages in the midst of plenty. And it will take some time, we think, for these dislocations to unwind.
Yeah, Gary, I think what you just said played out in the JOLTS report today. We saw job openings in the U.S. Inch up in May, but hiring actually dipped. When do you think the labor shortages, though, might actually start to trip up the economic recovery?
Well, we're hoping that we will see that transition during the latter part of the year. It may slow growth at the margin. Fortunately, we have the reopening of the economy, a tailwind there. We are hiring. There are shortages. So it's really less apparent on economic growth. Certainly growth would be a bit higher had we have the businesses been able to hire at the rate they'd like. But with the reopening, the strength and demand from drawing down high savings, the wealth that's created from the stock market, we do expect to see growth slowing, but still at a rate well above average. But that, in part, because of that very strong economic growth, that will keep the labor market under some strain right through the end of the year.
Now we're starting to see, a lot of employees demanding better pay and other benefits like flexibility to work from home. And while turnover has always existed in the labor market, we have seen a higher rate of turnover lately. How long do you see that continuing, especially as so many folks have said, listen, the summer months, we're going to be seeing these peak levels of folks getting hired?
Well, we should see noticeable relief. We're hoping to see noticeable relief after September. A couple of things happen then. You have the child care issue, many people staying home to watch children. Hopefully the schools will be reopening in greater numbers then. Some of the enhanced unemployment insurance benefits already are coming off in some states, but they will come off more noticeably in early September. So that issue as a lure to keep people out of the labor market should dissipate as well. And we're hoping as well that the concern about vaccinations, concern about the coronavirus will continue to dissipate as well. So a couple of things coming together that hopefully will increase the supply of labor during the closing months of the year. But still some tightness in the market, and we expect to see that persist well into 2022. This is going to be a fairly gradual process, an unwinding. Keep in mind that many of us are expecting to see growth moderate over the course of next year. So that will take some of the pressure off the labor markets as well, if not sooner than that.
What about in terms of wages? Which industries have, seen the biggest jump in wages during the pandemic? There was talk that perhaps it was some of the lower paid workers in the service and hospitality industry, because there was such a shortage there that those companies had to raise wages in order to entice people to come in.
Well, it was focused on those frontline industries, leisure, hospitality, the entertainment industries, other services industries initially. It is becoming a bit more pervasive now. We are seeing wage pressures permeate the labor market to a greater extent now. We do view that as temporary. It just depends on how you view temporary. Ultimately, though, we think that as these dislocations begin to ease over the course of next year, you will see wage pressures dissipating more noticeably. But at the moment, they're a direct outgrowth of the labor shortages. If anything, they become more widespread and deepening a bit as these labor shortages persist. I might add that in today's JOLTS report, we were beginning to see early evidence of a peaking of these shortages. We're not there yet, but the increase in openings smaller than what we've seen over the past 6 months, and the decline in hiring not quite as great as what we expected. In other words, the gap between job openings and actual hiring, it continued to increase, but not at the same rate. So hopefully we're approaching that peak, and conditions will improve as we move through 2021 and into 2022.
Gary, any of the scarring that we're seeing from the pandemic on the labor market, do you see any of it as being permanent? What permanent changes do you think are being made to this labor market going forward?
Well, I think the most obvious that we're monitoring at the moment, the number of retired workers. By some estimates, I think the Dallas Federal Reserve estimated that something like 2.6 million workers retired during the pandemic, about 1.5 million more than what we would normally expect to see during an economic cycle. And the loss of those workers, and I might add, the odds that they stay on the sidelines is that much greater than it was during the last economic cycle, because household finances are in far better shape this time around. The run-up in the stock market, rising home values, really created a contrast, I think, to the situation after the global financial crisis about 10 or 11 years ago. So these workers are likely to remain more inclined to remain on the sidelines. You get a double-barreled effect on wages. For one thing, you lose that supply of labor, but then secondly, these workers tend to be a bit more productive. Absenteeism tends to be lower. Because you lose that productivity, that could add to the pressure on what we call unit labor costs for businesses as well. Not an overriding factor, but one of the more apparent impacts, we think, of the pandemic. The other is the ongoing issue of a skills mismatch between the strong demand for skilled workers and the added supply, surplus, if you will, of unskilled workers. That was an issue even before the pandemic. It seems to have been accentuated after during the pandemic, and we expect to see that issue linger on to a greater extent as we move through 2021 and into the new year.
All right, Gary Schlossberg, Wells Fargo Global Strategist, thanks so much for joining us.